Vanakkam, Namaskar, and welcome to all the viewers and listeners of this episode of Fixed Income Markets by Sundaram Mutual Fund. The month started with a status quo on policy rates and stance by MPC, a decision widely anticipated, although be it the market expected a more dovish tone. Governor reiterated that the current growth and inflation mix gives the MPC the opportunity to pursue aligning the inflation to median target of 4% for sustaining a higher GDP growth for a longer time frame. Inflation printed at 3.54% year on year on account of benign base when last year the inflation was 7.44% and fiscal year quarter 2 forecast for inflation by RBI has been estimated at 4.4%, which is likely to undershoot by 30 to 50 basis points. Food inflation has been the larger culprit and it was for the first time below 8% since October 2023. The prices released by Ministry of Consumer Affairs for essential commodities on a daily basis show that barring tomatoes, which is in deflation from a year ago, onion and potatoes are still continuing to rise in price from a year ago period as on 3rd September 2024. Core inflation has also shown an uptick, although be it well below the 4% mark. GDP was released for quarter 1 fiscal year 25, which printed at 6.7%, almost around the consensus of 6.8%, but GVA surprised on the upside, printing at 6.8%. GDP grew at a slower pace, probably on account of election model code of conduct, where government expenditure was restricted as evidenced by government consumption in negative territory, while construction and private consumption remained strong. Sustainability of the same is questionable on account of urban consumption slowing down and services growing at a slower clip. Also, the gap between GVA and GDP reducing will be largely on account of subsidies. Again, as the government spends and elections in major states, the gap could increase from here. Overall, in the global context, Indian economy has been doing well, barring the factors which have global linkages like exports have been slowing, taking the recent trade deficit numbers higher. Regulatorily, the focus of the central bank will improve the asset quality but will check unsecured lending, slowing loan growth in addition to challenges in garnering deposits. This could further dampen consumption and in turn growth. On the global front, the Federal Reserve is likely to cut rates in its meeting on 18 September 2024 by 25 to 50 basis points. We expect it to cut by 25 basis points. The federal chair has been unequivocal on not letting the unemployment rate climb on account of restrictive monetary policy. Jury is still out on the probability of recession hitting the US, but the current set of data has been mixed, although be it in our opinion fueled by the government spending and widening fiscal deficit. Eurozone has been witnessing easing inflation and declining growth, particularly in larger economies, setting the stage for further rate cuts by ECB. China has been grappling with Japan-like situation as reviving consumption is challenging as a large part of the households is locked in real estate, directly and indirectly. Low confidence in consumers inhibiting them from spending despite making borrowing quite lucrative by Chinese government and central bank by cutting rates, easing reserve requirements, and there is a contemplation of local bond issuances by provinces to fund buyback of unsold homes to get the real estate sector moving. This is also pushing goods in deflation globally as we see steel prices correcting, demand for oil being muted, etc. On the other hand, Bank of Japan increased the key interest rate to 0.25%, sending the markets in a frenzy on unwinding of yen carry trades. Defined as borrowings in low yielding currency to investments in high yielding currency assets, raising the rate resulted in yen appreciation, making it costly for the yen borrower to repay the loan, thus forcing them to unwind the trades. BOJ soothed the market by allaying fears of further rate hikes without taking into account the market reaction. Taking all these factors into account, we can see that the environment is slowly turning bond conducive, as most countries have either cut rates or are in the process to start cutting rates. This will bring down the yield of the front end of the curve as inflation outlook remains mixed and central bank may resort to a shallower rate cut cycle, keeping in mind the global debt, particularly led by the United States, which can result in inflation being sticky on the downside, while goods inflation is likely to be checked by the inundation of cheap Chinese goods on account of weak domestic demand there. Liquidity has been largely in surplus, keeping the overnight rate anchored to the repo rate. Although, as expected, lumpy spending by the government is keeping the system supplied with more liquidity than demand for fund, pushing the overnight rate towards the SDF rate. We expect this sawtooth movement to persist as we see the half-yearly advance tax outflow in September. Deposits in the last few fortnights has overtaken the credit in absolute numbers, as also indicated by the incremental credit deposit ratio clocking around 50%, much lower than almost more than 100% in the earlier fortnights. Taking these factors into account, we continue to remain invested in a mid-duration strategy for benefiting both from a reasonable accrual income and possible larger downshift of the yield curve up to the belly of the curve, giving investors a better risk-adjusted return experience. For savvy investors who can time the market, they can invest in longer duration products for shorter time frames. Mid duration products from Sundaram are corporate bond, banking and PSU, and short duration fund, while more conservative investors can match their duration with investment horizons, and cash management products like overnight and liquid can be used as an investment vehicle. Thank you and see you in the next episode.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.